Hello, everyone, and welcome to this first module. I'm Ludo, and together we are going to build your foundational knowledge in auditing. This first section is the most important, as it defines the why and the what of our profession. Okay, so here's what we're going to cover. We'll kick things off with the big why, the purpose of an audit. Then we'll look at the two main families of auditing, what it takes to be an auditor, how we actually do the work, and we'll wrap it all up by showing how the financial statements all fit together. Sound good? Let's dive in. All right, first things first. We've got to start with the biggest question of all. Why? Why does our profession even exist? Seriously, getting this right is the foundation for everything. And I mean everything we're going to talk about. So just imagine for a second, you're thinking about buying a company, or maybe you're a bank about to lend out millions of euros. They slide their financial statements across the table. How on earth do you know if those numbers are legit? Can you really trust them? Well, that feeling, that uncertainty, that's exactly why we're here. We are that independent voice of trust. Okay, let's get one thing straight right off the bat, because it's a huge misconception. Our job is not to find every single tiny error or act of fraud. I mean, that'd be impossible, right? Our goal is to provide what we call reasonable assurance. And that's a key phrase. It means we give you a really, really high level of confidence, but it's not a 100% ironclad guarantee. So we're not out there with a magnifying glass looking for every little mistake. We're hunting for the big stuff, what we call material misstatements. And material is just a fancy word for big enough to matter. Think of it like this. a €1,000 error in a giant company, who cares, right? It's just noise. But a €10 million error, oh yeah, that could absolutely change an investor's decision. That's what we're looking for. And who's making these big decisions anyway? Well, pretty much everyone. You've got investors trying to figure out where to park their cash. You've got bankers trying to size up risk. You've even got employees who just want to know if their job is safe. The government, customers, suppliers, they all rely on our work to get a clear picture of a company's health. Okay, so we've got the why down, but now you need to know that not all audits are created equal. In fact, you can pretty much split them into two big families, external and internal. So let's break this down. The external audit, that's us, the outsiders. We're an independent firm, and our job is to report to the shareholders, to the public. Our whole goal is to give that stamp of approval, that true and fair view. Now, internal audit is completely different. These guys are company employees. They work for management, and their job is to help the company get better from the inside out. So you can think of it like this. External audit is about building trust with the outside world. Internal audit is about making the company stronger on the inside. All right, we've covered the why and the what. So what about the who? What does it actually take to be a good auditor? And let me tell you, it's about way more than just being a whiz with a calculator. If you're just starting out, there are 3 things you absolutely have to have. Number 1, rigor. You've got to be obsessed with the details because trust me, that's where the truth is hiding. Number 2, integrity. This is the big one. It's the absolute foundation of what we do. If you're not objective, the whole system falls apart. And finally, number 3, clear communication. It's great if you find a problem, but if you can't explain it to the client in a way they understand, well, what's the point? Okay, so we know why we do this and who does it, but how? How do we actually, do an audit? Let's pop the hood and take a look at the toolkit. So, the heart of all modern auditing is what we call the risk-based approach. We don't just show up and start checking every single invoice. That's not just impossible, it's a waste of time. We work smarter, not harder. We start by becoming experts on the company. We learn their business inside and out so we can find the weak spots, the areas where things are most likely to go wrong. And then we focus all of our energy, all of our testing, right on those high-risk areas. It's like being a surgeon with a scalpel, not using a sledgehammer. And this idea ties right back into what we were talking about earlier, materiality. To make this risk-based approach work, we have to draw a line in the sand. We have to put a number on what big enough to matter actually means. And that number is our materiality threshold. It's a specific euro amount that we, the auditors, set right at the beginning of the audit. So this number, this 10 million euros, becomes our benchmark. Any errors smaller than that, we consider it background noise. But an error bigger than that? Now we're talking. That's something that could seriously sway an investor's decision. And that's where we zoom in. All right, let's get a little technical for a second, but don't worry. This looks like a scary formula, but it's really just a simple way to organize our thinking. This is the engine behind our risk assessment. The whole point is to keep our audit risk, that is, the risk that we make a mistake and give the wrong opinion, as close to zero as possible.
It's basically made of three pieces. First, you have inherent risk. Some business areas are just riskier than others, right? Like valuing a complex financial derivative is way riskier than counting chairs in an office. Then there's control risk. That's the risk that the company's own internal checks and balances fail to catch a mistake. Now here's the punchline. If those two risks, the client's risks, are high, then we have to do everything we can to lower our risk, the detection risk. And how do we do that? Simple. We do more testing, more digging. We work harder to make sure we don't miss anything.
Okay, for our last section, let's zoom out. This is super important. A good auditor never, ever looks at a number by itself. You have to see the whole chessboard. You have to understand how the three big financial statements, the income statement, the cash flow statement, and the balance sheet, all talk to each other. They're all part of one big interconnected story. And the best way to see this is with an example. So let's do a quick case study. Imagine a company has a 10 million euro depreciation charge. Now, remember the key thing about depreciation: no actual cash is leaving the building. It's a non-cash expense. So with a 25% tax rate, let's see how this one single entry creates ripples across all three statements. Let's follow the money, or in this case, the lack of it. Okay, first up, the income statement. Pretty straightforward. That 10 million depreciation hits as an expense. So income before tax goes down by 10 million. But wait, here's the interesting part. Because our profit is lower, we pay less tax. With a 25% rate, that's a tax saving of 2.5 million euros. So when you do the math, our final net income is down by 7.5 million euros. Now for the cash flow statement. This is where it gets fun. We always start with net income, which we know is negative 7.5 million. But then we have to add back the 10 million in depreciation. Why? Because it wasn't a real cash outflow. So what's the result? Negative 7.5 plus 10, our operating cash flow actually went up by 2.5 million. It seems weird, but it makes perfect sense. That tax saving of 2.5 million is real cash that we got to keep. And finally, let's see how it all balances out on the balance sheet. On the assets side, our fixed assets are down by 10 million because of the depreciation. But our cash went up by 2.5 million. So the net change to our assets is negative 7.5 million. And on the other side, liabilities and equity, while our equity went down by 7.5 million thanks to the drop in net income. And look at that, minus 7.5 on both sides. It balances perfectly. Being able to trace this flow is an absolutely essential skill. Okay, so let's do a super quick recap. The why? It's all about providing reasonable assurance to build trust in the market. The who? You've got external auditors certifying the numbers and internal auditors making the company better. The how? We use a smart, risk-based approach that focuses only on what's material. And the big picture is knowing that all these financial statements are telling one single connected story. So there you have it. You've got the foundation now, the absolute core principles of our profession. The real question is, are you ready to take the next step? Are you ready to build on this and dive into the specific standards and regulations that shape everything we do? I hope so. I'll see you in the next module.